At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers board voted to file for bankruptcy, erasing $639 billion in assets and plunging the world into the worst financial crisis since the Great Depression. It's Friday, September 12th. Lehman CEO Dick Fuld paces his 31st floor office, staring at a $60 billion commercial real estate bet gone toxic. His promise to shareholders that Lehman would never need a bailout now sounds like a death warrant. Fuld knows the firm has only $1 billion in ready cash, enough to last maybe 2 days. He calls Treasury Secretary Hank Paulson, begging for a lifeline. Paulson's response is ice cold. There will be no public money. The clock starts ticking. Saturday dawns with a sliver of hope. Korea Development Bank is in talks to buy Lehman. Fuld's team works through the night, but at 10 a.m. Seoul time, the deal collapses. KDB demands government guarantees, and Paulson refuses. The news leaks. Lehman's last white knight has vanished. In New York, traders whisper that Barclays might step in, but without a guarantee, it's a long shot. The firm's stock has already fallen 94% in a year. Time is now measured in hours. By Saturday afternoon, the Federal Reserve Bank of New York becomes a war room. CEOs of all major banks are summoned. Paulson and Fed President Tim Geithner deliver an ultimatum. The industry must find a private solution for Lehman by Sunday night or face systemic collapse. They split into teams, one to value Lehman's toxic assets, another to fund a bailout. But the numbers are staggering. $30 billion in potential losses. No one wants to touch it. Sunday morning, Barclays emerges as the only buyer. But there's a catch. British law requires a shareholder vote, which could take weeks. Paulson calls UK Chancellor Alastair Darling, pushing for a waiver. Darling, haunted by the Northern Rock run, refuses to import America's toxic debt. Across the Atlantic, Fuld is on a conference call, hearing the news. His voice cracks. We're out of options. The betrayal is complete. Wall Street's club has abandoned one of its own. What the public doesn't know, Lehman's collapse isn't just about subprime mortgages. The firm used a secret accounting trick called Repo 105, moving $50 billion of debt off its balance sheet before each quarter to appear healthier. Auditors at Ernst & Young signed off. This hidden leverage, 30-1, meant a 3% asset drop wiped out all equity. When the market turned, Lehman was a house of cards. The mechanism was legal, but the consequence was catastrophic. As Sunday night falls, 25,000 Lehman employees face the abyss. In London, traders pack boxes, cry in the halls. In New York, a managing director collapses from a heart attack. Their 401(k)s, stuffed with Lehman stock, are now worthless. One analyst recalls, "I lost $800,000 in a day. My kid's college fund gone." The human toll is immediate and brutal. This isn't just a financial story. It's a story of shattered lives. At 6 p.m. Sunday, the Fed's boardroom is chaos. Geithner demands a final vote. Who will fund a Lehman rescue? Silence. Bank of America has already fled to buy Merrill Lynch. Barclays is blocked. Paulson, a former Goldman Sachs CEO, makes a fateful choice. No bailout. He believes the market has had time to prepare. He's wrong. At 8 p.m., Lehman's lawyers start drafting bankruptcy papers. The decision is made, not with a bang, but with a quiet nod. Monday, September 15th, 1:45 a.m. Lehman files Chapter 11. Within hours, the Dow plunges 504 points, the worst drop since 9/11. But the real shock hits money market funds. The reserve primary fund breaks the buck, falling to 97 cents. A run on commercial paper freezes global credit. Overnight, companies can't make payroll. The crisis spreads to Europe, Asia, everywhere. The mechanism, interconnected derivatives no one understood. The cost, $10 trillion in global market value lost. By Tuesday, AIG teeters on the edge. Paulson, who refused Lehman, now rushes an $85 billion bailout for the insurer. The hypocrisy stings. Why save AIG and not Lehman? The answer: AIG's failure would vaporize the entire banking system via credit default swaps. Lehman was a sacrifice, a lesson the market had to learn. But the lesson was too expensive. 8.7 million jobs lost in the U.S., 10 million homes foreclosed. The human stakes were never higher. Lesser-known fact. In 2007, Lehman's own risk manager, Madeline Antoncic, warned Fuld about the real estate bubble. She was sidelined. Another fact. The SEC had embedded examiners inside Lehman since March 2008, but missed the Repo 105 trick. And on September 11, 2008, 4 days before bankruptcy, J.P. Morgan, Lehman's clearing bank, froze $17 billion in collateral, demanding cash. That was the final blow. The mechanism of death was a liquidity chokehold, not just insolvency. 15 years later, Lehman's ghost still haunts. The bankruptcy estate has paid creditors only 21 cents on the dollar. Fuld, unrepentant, runs a small advisory firm. The open question from that weekend, why did they let it die, has a simple answer. No one wanted to catch a falling knife. But the deeper truth is that the system was built on trust, and when trust evaporated, so did $639 billion. The lesson in finance: panic is the only true contagion.